Hey, what's going on, everybody? Corey Dow's at Aris Realty again, coming at you with some more information about the real estate market. This video is specifically for buyers. Whether you're a first-time home buyer, somebody who's thinking about buying, maybe buying in your plans, maybe a year, 2 years from now, maybe you're somebody who bought 20 years ago, just hasn't done it in a while, this is for you. This is an update, not so much on the market, but just on the process, letting you guys know some terms you should be familiar with as you make your foray into this arena of home ownership. Just a way to give you a leg up against the competition who maybe they don't see this video, maybe they don't understand these terms, maybe they're not exactly sure what they're getting into. You're going to be well prepared. You're going to have the advantage over anybody else looking at the same house you are. And that's what this is all about, helping you guys out. So bear with me as I give you a lot of information in a short period of time. Don't be overwhelmed. You can watch this video 100 times. It'll help you out. I promise you there's some good information buried in it, and you'll be thanking me down the road. So right off the bat, you've decided that you want to buy a home. How do you do that? Well, the first thing you're going to want to do, unless you got mountains of cash laying around, you're going to buy the property outright cash. Good for you. Can I get some? You're going to want to talk to a mortgage lender, and they're going to be able to give you information that personally I just can't. They'll be able to give you up to the date mortgage rates, interest rates. They'll be able to tell you, the different programs that they might offer that maybe another place doesn't, and they'll be able to give you some more insight into what's going on and why the rates are driving the way they're driving that realtors aren't really allowed to talk about. But what I can talk about is what your lender is going to need. And they're going to pull various different data points about you and your credit history, your financial history, to make sure that you're a person that they can lend money to and expect to get it back. Now, the number one thing that tells you that is your credit score. That's a number from 300 to 850 that is really just a full scope of your entire financial history that tells a lender whether you're going to pay the money back that they lend you or not. Now, if you're under like a 580, it's usually tough to get a loan. Some lenders will work below that, but what they all do and why you should talk to one sooner rather than later. And if you need a referral, please reach out to me. I work with a ton of great ones. I'd love to put you guys in touch. And, you can both go home happy having met a cool person that day. So if you aren't quite there yet with your credit score and you need to get there, talk to a lender because they will be able to tell you, pay down this, don't worry about this, and we can get your score up in, however many months it might be. Now, there are ways that you can pay something down and instantly be good to go. I don't know exactly the numbers for every single personal situation, but you know who does? A qualified and licensed mortgage lender. They'll be able to help you out. So, step one, talk to the lender. Once you talk to them and they give you the all clear, they say, hey, you have a great work history, strong job, strong income, very low debt, high income, great credit score, yada, yada, they're going to issue you a pre-approval letter. Once you have that pre-approval letter in hand, then you're good to start going to look at houses. Now, you can look at houses before you get a pre-approval. There's no law against it. The problem is if you fall in love with something, you're not going to be able to buy it. You could put an offer in, but if it doesn't come with a pre-approval attached to it, no seller is going to take it. It's just the harsh reality of the world that we live in. I mean, somebody puts an offer in, you accept it, they don't have a pre-approval letter, and then all of a sudden you find out that they're not authorized to buy a house. They don't have the money. Well, you just burned that seller, and now that seller has to go back on the market. People start asking what's wrong with the property. It's just one of those snowball effects, right? So the easiest way to avoid that is to have every single buyer already pre-approved before you walk in the door. And not only do you kind of protect your sellers in that situation and the homeowners, but you protect yourself from falling in love with a property that you might not be able to afford. I've had it happen a million times. People looking at houses, 700, 800,000, they go get pre-approved and they're only authorized for 450. Well, they've gotten so accustomed to that high price range that now the 450s just seem like, oh man, this house is a bit of a letdown. When had they just started there, they might have loved it. So don't let that happen to you. Don't fall victim to that. Get pre-approved. Know where your budget is. Know what you should be looking at. And then remember that when you get your pre-approval letter, you don't have to spend every penny they give you. If you get pre-approved for $1 million, you can still save a ton every single month by buying a $700,000 house. I mean, heck, you could buy a $300,000 house and have a monthly payment that's almost nothing to you. So definitely something to think about when it comes to pre-approvals. Definitely talk to a lender. They'll be able to give you all of the insight and all the information that you need to make an informed decision about what house you're going to buy and at which price point. The next thing they're going to be able to talk to you about, and what we can kind of talk more about as your realtor, is your down payment and your eventual closing costs. Now, these two things combined are often referred to as cash to close. And that's really the amount of money you need to bring to the closing table on the day of closing on your property in order to actually close on the home. Your down payment is going to be determined by your loan program. If you are an FHA loan, you're looking at 3.5% down payment. That's a 3.5% of the purchase price of the home. If you're on a conventional program, those are a little bit different. You can be at a 5% down payment, 10%. I think they do a 15 now, a 20. And again, I know I'm going to keep saying this. It's going to get annoying. A lender will be able to tell you exactly what programs they offer for conventional loans. Now, a conventional loan could go all the way up to 50%. It could be 75%. Whatever you have down that you feel comfortable putting down to make your monthly payment more palatable, by all means, go for it. Just talk to your lender, make sure it makes sense to do that. Closing costs are a little bit different. Those are the fees that you pay at closing, required to close on the property that you've worked so hard to get to that point anyways. These fees are all kind of small, and they're outlined for you line by line on your eventual ALTA statement, also called a closing HUD disclosure. Everybody calls it a different thing, but what it is a line by line itemization of where every single penny goes for your closing costs, for your down payment, for the price of the home, any prepaids, stuff like that. Your closing costs are going to include origination fees, title fees, if you opted into title insurance, which most people do, various different things like that all total up to somewhere around 3, 4, 5% of the eventual closing, purchase price of the home, rather. So if you're looking at closing costs and your down payment all together, again, that's referred to as your cash to close. Don't bring cash. It's going to usually be a certified check, a bank check, sometimes a wire transfer if you're comfortable doing that. Be careful of wire fraud. It's very real. That's one thing you'll hear realtors say all the time. We do not want you to wire your money to somebody that you shouldn't be wiring it to. So if you can do a bank check, that's usually the preferred method. Back to actually the home buying process, right? So you go ahead, you find a home, you love it, you put the offer in, you're on cloud nine. In order to do that, you need to have a purchase and sale written. Purchase and sale is also referred to as a P&S, purchase and sale, and that is going to be your not legally binding document, but it kind of is, and it's going to outline all the dates, whether it's the date the offer is written, the anticipated closing date, the date of any inspection window that you may be negotiating, the date of anything else that you can possibly think of. It's all outlined in there, so it really just becomes a step-by-step guideline to how the transaction is going to go. And I just touched on the inspection briefly there. I'd like to kind of elaborate on that a little bit. An inspection contingency or an inspection window is something that realtors write into purchase and sales, and that will protect you from perhaps a large project being unbeknownst to you that comes up. Now, hopefully, when you hire a licensed home inspector to go through the house, they do so thoroughly, and they find any of those defects ahead of time. So you can make an informed decision if you want to continue with the purchase of the property. If you don't, you should be able to pull out as long as you have a correctly and effectively written inspection contingency in your purchase and sale agreement. That should allow you to pull back or pull out of the deal while returning your deposit. And your deposit is usually, depends on the state. New Hampshire, typically, it's just a couple $1,000s. Massachusetts likes to do a percentage of the purchase price of the home as your earnest money deposit, which essentially binds your offer and makes it legitimate and real. Now, you want to make sure that that money is protected, and that's where your agent comes in. And if they're doing their job, which they should be, you should be able to say, I found X, Y, and Z at inspection. I'm no longer comfortable with this property. I would like to pull out and have my deposit returned immediately. At which point, hopefully the seller will say, yes, no problem, here you go. They can also offer to repair it. You can negotiate the repair, replacement, or just pull out altogether. Those are your options when you have an inspection contingency. If you don't, you're kind of stuck, and you're not going to be able to negotiate any of that stuff. Now, some people do opt to go that way if they're comfortable with, let's say you're a contractor and they're comfortable with projects, nothing's going to come up that scares them. Some people will waive an inspection contingency to make their offer more appealing. It's just a little risky if you're not the do-it-yourself type of person. So something to think about there. Really, the next step, if you get through inspection, say everything goes clear, nice and clean, you make your way through. The next thing in the process is going to be your appraisal. So what is an appraisal? It's not an assessment, which people tend to mix the two of those up. An assessment is what the town does or the city does that you live in that determines your taxable amount or assessed value of the home, and that's what your taxes are based on. Your appraisal is entirely different. The licensed, qualified, third-party appraiser that kind of works for the bank or the mortgage lender, they all own their own companies really, but they're authorized by the bank to go in and give them an expert opinion of value. Now, how do they come to these numbers? Usually comps. Usually they're going to do a sales approach to see what is sold in the area that matches your bedroom, bathroom layout, square footage, style of home if they can, acreage, yada, yada, yada. Now, if they use the sales approach, usually you end up with kind of a similar report to what a realtor is going to pull when they put the property on the market in the first place. So that's usually pretty cut and dry. It's just pulling comps. They go through the house. They make sure everything is as it's supposed to be. If it's a multifamily, they can use an income approach to determine value that way, or you can do a replacement cost approach. So imagine that your house was completely devastated and destroyed. You would get replacement costs, but that's typically in this market, the way things have shifted, not a reliable model. So I don't think I've ever seen an appraiser use a replacement cost model at this point. So an appraisal, though, for you as the home buyer is really just a professional expert assessment of what the home is determined to have for value. And let's say you offer $350,000 for the home. Hopefully your appraisal comes back at least $350,000. If it doesn't, and you don't have an appraisal contingency written into your offer, then you're going to owe that difference in cash, unfinanceable at the time of closing. And that would be on top of your closing costs and down payment. Most people don't want to do this, so that will lead to another round of negotiating with the seller or potentially you having to pull out of the deal. But if you don't have an appraisal contingency, you don't really have a right to pull out of the deal unless it would absolutely financially ruin you. So it's certainly something that most offers should have, is an appraisal contingency, unless you are comfortable eating a large chunk of additional cash. Now, if it's a $1,000 or $2,000 difference, by all means, I don't think you're going to be pulling out of a deal over a small amount like that. But I've had experiences where there are larger gaps, and thankfully we've had appraisal contingencies written in, so it just became some more negotiating and, two realtors kind of hashing it out, getting it done, so everybody feels like they, gave a little bit of ground. But if you don't have one, there's no reason for the agent to negotiate at all because they don't have to. So something to keep in mind. And then with the appraisal also, that leads me to my final point is the term equity. Now you hear equity tossed around not only in real estate but in different different walks of life. But as far as real estate equity, we're talking about the value of your home above the combined value of any liens against your home. Now, a lot of people don't think of it this way, but a mortgage is really just a 30-year lien against your house. So if you, say, bought a house for $350,000 and it appraises for $360,000, you have $10,000 of instant equity right there. Your house you're being told worth $360,000. You only paid $350,000. Boom, $10,000 in your pocket, so to speak. Now, that equity should increase year over year, month over month, as you continue to pay down the $350,000 that you borrowed. And hopefully, with market conditions, your property continues to increase in its own value. Now, that is going to increase your equity. And we saw that happen in this past couple years where the market kind of exploded because a lot of people were pulling out the equity from their current property. Maybe they bought it in the 70s, 80s, 90s for $50,000, $60,000. Now it's worth $500,000. They have all this equity just stashed, stored up. It's a fantastic position to be in, and one of the reasons that home ownership is one of the biggest investments that most normal people make in their lives. So if you can build monstrous amounts of equity like that, you're positioning yourself financially for just extreme growth through the rest of your life, really. So equity is a big term for you as a buyer. It's a big term for realtors. We want to see all of our clients get equity, make equity, grow equity in their homes. And we toss the phrase around a lot because it's really the most important thing that you should be thinking about when you come down to home prices. And if you check my other video about the property values finally hitting rock bottom, you can see that there's a tremendous opportunity for equity to be built if you are to get in a house now the next few months, even the next year. If it's something you're thinking about, give me a call, please. I'd love to talk you through it, talk you through how to build some equity, talk you through how to get a house. If maybe you just want to get out of your rental situation, you're throwing money to your landlord's mortgage every month instead of your own. Whatever your situation might be, please give me a call. Again, Corey Dowse, Aris Realty, 978-877-2817. Please reach out any way you can. Facebook, Twitter, Instagram. I'm on all of them. You can find me. Hopefully we touch base and we can get you into a house sooner rather than later.